This is Monty Brem, Stepstone Group. I'm here with Han Seng of UOB, and we're at Super Returns Beijing. And we're going to discuss a bit about some of the things that are happening here in China and Asia more broadly. So Han Seng, now that we're going through a bit of a more difficult period here in China for private equity, how are you thinking about private equity in the overall mix of your Asian portfolio?
You're right that...
I apologize, China in the overall mix of your,
no worries.
your Asian portfolio.
I think you're right that the situation in China is challenged, but I think the situation is not that much different in the other developing economies. I think India is having a far more challenging time, and if you look at India, it looks a little bit worse to an investor because the government policies are not even vaguely helpful. Whereas in China, at least, it's always talk about reform and the government really wanting to help things out. So in that sense, it's a little better that the government is actually supporting a lot of the efforts. And there are still a lot of areas to develop in China. Southeast Asia obviously is another area that has received a lot of interest recently. I think we continue to see that as an interesting area, and I think that's also reflected in performance in the listed markets. But it is a relatively small area of investment, and a number of deals have been relatively small. So in a sense, it also bothers us that there are so many people wanting to invest in what has historically been a very small areas, and historically many funds have tried to establish themselves in Southeast Asia, but really finding it difficult to kind of find a deal flow, and the people who have historically been there have had to expand their investment horizons to India and Australia and even China in order to fill up the fund, so to speak.
Have you seen, are we getting to the point where you're worried there's just too much capital coming in too fast? Because, from my experience, you're certainly right that it's become very fashionable to say that Southeast Asia is a place to invest in private equity.
Yes. I think generally, yes, we do feel that the world today has got excess liquidity, low interest rates. So there's a lot more money than opportunities. And it's not helped by the fact that on the supply side, you see a lot of money. On the demand side, the macro environment's uncertain, companies' earnings haven't quite improved. So we do see that there is a disconnect. But I think what we do see as well that money seems to be flowing towards certain themes. Big funds, for example, if you're a very established Chinese fund, in a very general space, you get $2+ billion. And so the challenge for us really is to find spaces. If you look at a broad basis, yes, it looks there's a lot of excess liquidity. So the challenge for us as investors here to look for spaces where it's less interesting, where on the margin we see that the balance between the supply of capital and the supply of opportunities improve marginally. So even though India and Australia look like they are uninteresting markets, we continue to walk the ground and look at the bottom-up opportunities.
So do you think that there's really anywhere in Asia where you can avoid what's happening in China? So, one of the things we always get asked about from our clients is, can we put something in the Asian portfolio that'll give us some kind of diversification from whatever happens in China going forward? A little bit more balance. They kind of think everything they're doing in Asia is basically derivative on the Chinese market.
Correct.
Do you think there's anywhere you can hide? Is it basically whatever happens in China will drive ultimately the returns in Asia, or are there kind of pockets that are a little bit more immune to the ups and downs of the Chinese market?
I think that Asia is a broad enough geography that you can build together a fairly balanced portfolio. I think in response to some of the challenges or some of the feedback that clients are saying about developing economies. If you don't do China and India, then really that's why Korea is becoming so interesting.
Right.
Korea and potentially Japan. When the yen is weakening, it's tricky for you to put money in, but eventually you'll get to a point where corporates could improve. And that's also why Southeast Asia is improving, because the dependency on China is not that great. I think the thing that we feel really is that we think China is going to go through a period of adjustment and slower growth. If China were to go down the drain in a crash, then all bets are off. But if China goes in a stage of adjustment, then there could be interesting opportunities. Already the region as a whole is not going to go down, and you can still build a fairly balanced portfolio that could avoid the issues of China.
So Han Seng, you've been investing in Asia for a long time, and inevitably history repeats itself. So, I mean, what you're seeing in China today, can you draw on any of your experiences in Asia historically and kind of start to develop some potential ideas about where either the Chinese macroeconomy is headed and what direction that might take, or just private equity in generally in China and how that may evolve?
Well, I've been investing in Asia since '97 and kind of seen the Asian financial crisis. So
Yes.
I have some context about the questions that you asked. However, I think I need to paraphrase that by saying that China is very different. We've never had in Asia an economy so large, which that much of a domestic economy and a government with that much resources to actually resolve all the issues. If you throw your mind back to '97, really very small economies, export oriented, external funding, and once the external funding goes, the economies collapse, and there's really nothing much you can really do within that. So China is a little bit different for us, but I think a couple of things come on that you can learn where history rhymes but not exactly the same.
Yes.
I think we're going to have to think about investing in China a little bit more differently. The go-go years of China where you just put money in and you're going to make a lot of money,
Right.
I think it's different. I think you need to think of a different way of doing things. You need to be either more specialized in the skills, you need to be more operational value added, you need to be more disciplined. But if it's just, trying to get the beta, I think that has passed. If you look at Southeast Asia in '97, it hasn't really quite recovered until quite recently. So it's a long time before the same beta-led growth. But the economies have been quite nice and there are opportunities. It's just that the same old thing we think is not there. So when you look at investments, it's no longer the same old beta-driven stuff. And also, I think it's become more difficult today because of what needs to be done. Therefore, small teams of 2 men and a dog probably is going to have a hard time in creating the value and doing the diligence.
Right.
So I think that's a few observations I have about past. But again, it is cyclical in Asia. And when valuations come back down to an attractive level, growth will come back and opportunities will come. And I think China is very different, as I mentioned to you earlier, possessing a very significant domestic economy, which is more stable and potentially allows itself to be a master of its destiny in some sense without the growth in the external economy.
Right. Okay, excellent. Well, thank you very much, Han Seng. It's been fantastic talking with you.
Thank you, Monty.